Starting with our disclaimer, trading involves risk of loss of all or part of your trading account or more. Always use only discretionary funds when trading. Never trade any market with money you cannot afford to lose. And whatever you do, when you start trading a live account, I want to make sure you are using our Excel sheet. Okay? So scale the risk above the waterline. Quick, brief explanation of this might be necessary. Starting account balance. Let's shoot large here. So let's say you start a $50,000 account. Your first trades, every single trade should risk no more than 0.25%. Actually, it should be exactly 2.5%. If you lose 9 of those, this becomes the area where you rethink your trading strategy. Once you get above your starting balance, which is this white line, the water line, you get into the area of a 0.5% trade. And as you build this up, as you hit these milestones, when you're above 5%, and this would be your balance, so you can actually track your balance. When you get to 50,775, then you're going to 0.5. When you get to 52.5, you're at 1% and onward. Okay, until you get up into 3% per trade at around 66.5K. And what that does is it allows you to have fewer trades per week and you still maintain your inventory. The same exact thing goes if you're on a smaller account. There's no reason not to do the exact same math. Okay, so tonight we're going to talk about math quite a lot. And I wanted to pepper this in there because not enough people are using this. And I want to make sure if you're brand new and you're not sure about risk and it's an issue for you, make sure you understand the fundamentals of how to set lot size based on your stop loss distance. Okay, so if you open an account with $1,200, you could suffer 9 trades and it only goes down to 1,173. So you scale up as you build your account. You scale up the size of the risk per trade, right? So in this column, we have the risk per trade, and then you have how many trades a day until you walk away. So generally speaking, we're looking for 3 trade attempts per day. Okay? So this figure right here would pull you back to the previous line. That's why we adjusted these numbers. These are adjustable. You can go in there and tweak them, but I suggest leave them where they are. I spent some time making sure that this was actually very sound. So notice that if you're at this milestone, 1416, and you lose 3 trades, it takes you back to 1260, which is this next milestone. You never jump more than 2 spots. Basically, you should essentially only jump 1 spot if you hit a daily walkaway threshold. You'll see once you use it, it makes a lot of sense. All right, so I want to make sure people are aware of that tool. As we get going here, let me just as well, I'm going to pop the forum up and do a little modification in there just so everybody knows where that tool is. I know a lot of times people get a little confused as to where everything is in the forum, so I do apologize. We are traders first and teachers second, and I guess forum admins third. So let me come down into daily market review. Any tool that I bring to the method, doesn't matter what it is, an indicator, an Excel sheet, whatnot, it's going to be under this AFP tools. And these last 2, I did not make a link for it at the top, but I will. So let's do this. So scaled risk above the waterline spreadsheet. And I guess I don't need to do this with you guys here, but I might as well because it's something that's super important for your trading. Both of these spreadsheets are going to be super important, so I want to make sure you know exactly where they are. And we don't cover navigation in the forum quite enough. So here's your London pattern checklist. So let's get the sheet in here, right? So I'm going to modify this, and we'll just put it right above all this. And those are no longer new, so understand that. Let's do this one. So new, NEW, and then let's drop that in there. We'll go back and grab the link for it, which is right here. And then I will post the link directly to you guys here in GoTo, but it's here. Okay, so that, and then let me drop it to participants here live in GoTo. Copy. We'll use Patty's thing to anchor it to, and we'll send that link out to you. Very important to have that. And then, of course, the other one that we'll get to a little later. So new scaled risk above the waterline. Let's make sure all those are bold so it lines up, and then we're good. We're good to go on that one, okay? So we'll do the same. I guess I didn't do the here part. We'll do the same with the other sheet when we get to it. We're going to cover the other Excel sheet, which is in the process of evolution now. Whoops. Let me just go back and figure out what I did here. So that should be correct. Oh, I didn't have this thing at the end. Sorry about this, folks. But again, we're traders first. Form admin's third. Okay, there we go. Whoops, didn't like that one either. What am I? Your session timed out while posting. Okay. I'll come back and mess with that and make sure it's correct. But you get the idea. You know where it is now. Everybody that's here will absolutely be able to find it. AFP Tools, top link. I'll fix that. Oh, it did fix itself. That's interesting. Okay, we'll post the next one below. So let's get to the content here tonight. And welcome everybody to the DMR session here for the 26th of November, 2019. I'll ask you if you got any nice trades in last night. Anybody trade anything of interest they want to talk about? And as you think about that, let's go have a look at this Euro Canadian. We were in level 2 short. That was our level bias last night. So with Euro CAD, EC, we were in L2 short. We had our 5200 pointed down. We got the break of the Asia range, right? Nice break of the Asia range twice. And when they broke this Asia range, they also tapped back to a zone flip on the H1 chart. Did you see that? Right? Little tiny zone flip. These oftentimes I don't mark up ahead of time, but it turned into a nice type 1 London pattern. You just had to weather through this stuff over on the right. And this gentleman is here, Hamish. I hope I pronounced your name correctly, but he took a perfect entry on this. Basically the close below the catch up. This was one of our type 1Bs, right? It'd be this one. Leg 13 EMA tap, so it's a type 1B. So what it did is it went above the 13 EMA, came back and tapped the 13 EMA, did not close below it, and then closed back above it again, and then it closed below the 13. So that was a technically accurate entry on your part, sir, and your stop loss was in a perfect configuration. So we can just do a little guesstimation here. That's 1-to-1. That's 2-to-1. You got about a 3-to-1 on this, which is excellent. On a 15-minute chart, you can get a 3-to-1 if you wait till you're in the New York session, generally speaking. All right, so nice trading. Okay, definitely GU. Someone mentioned GU. Let's see what we have on GU. Tuesday. ID50 on GU. It didn't quite pull back to the water, but it certainly could have on some brokers. Some brokers you would have had this pullback. Okay, so we had an M1 long inside here that was quite nice, but notice how it terminated right at the zone flip. I know Jake was in this one. We need to brag on Jake a little bit here. He had a Euro trade from last week I want to show. So this is Jake's setup on a 4K screen. He's got an M1 on the right, M15 up here, M5 down here, bottom right, and then an H1, right? Quite a nice actual layout. You can dig in here, and you can see he's probably got the D1 sitting behind here. So he's liking watching one pair at a time, pretty much. He'll watch the pound, he'll watch the euro, but he stays pretty tight on these. And look at these entries. Very nice. Perfect execution entry. Took the first entry, and guess what he did? He added in on the pullback, which is beautiful. This is amazing. When you start to get confident enough that you know this is the false move, and you enter in again, basically it just either doubles the amount that you're going to make, or it allows you to make the amount that you're looking for, your inventory for the day, in less time. So this was, I don't know, 40 minutes tops. I mean, it was a quick trade. So thanks for sharing, sir. But look how nice the London pattern was. This, of course, if we can get a date on this, it's a 4K screen that he's got here. So it's the 22nd of November. So that was last week. And we can go have a look at that maybe. I don't want to, I've got a lot of content here tonight. So definitely checking out his areas that he's looking for possible zone flips at and monitoring that as it goes. Look at the zone flips that were happening on the H1 chart. Look how clean it gets when you're on one pair with one set of multi-time frame charts, right? So nice volume blocking inside there. Notice how it came to yesterday's day open price line. Very typical. So this is a nice trade. So nice going, Jake. Nice going, Hamish. Appreciate you guys sharing your trades. So that was EC. Rather, this was GU, sorry, but EC was, we covered that. Let's see what else happened last night. Another ID50 overnight in GC. Quite clear, right? You got the 5200 cross, comes down, pull back, tap the water, close below all EMAs except the blueberry. And then this was a nice move to plus 20, which would have been a nice TP inside here. So ID50 in GC, just in front of New York session. It wasn't quite New York session, but it was pretty close. And EF, if you're a fan of EF, a 5-minute type 1 London pattern last night. And UJ, interestingly enough, with a type 1 London pattern on the 5-minute as well, trapping through day open price, right? And look at the zone flip happening in UJ as well. We had this in a long bias. You had this in a long bias combo, right? We were looking at this early level 3 possibility with the harmonic that was playing out. This new harmonic had fired on this candle. So you really could have traded both directions. This was actually pretty nice. This is very, very nice type 1 London pattern on the M5. That's what you'd expect. Sideways chop until the New York liquidity comes in and then it pops up. So some nice sets last night. Let's get back to our yacht here. Let's see if we have anything on the M1 we want to cover from last night. Yeah, USD CHF had a glorious M1 trade. It's a pair I used to monitor a lot more than I do now, but still it does do this type of thing once in a while. Look at your trap highs going on the daily chart. Right? Didn't quite get through your quarter point figure, but you did put this nice break of Asia range, break of last week's high week, break of yesterday's high. So we had and inverted hammer. There you go. Especially tasty inverted hammer. Then we come down here to the M1 and it's glorious is the word. Right, so that's a beautiful M1 type 1 London pattern. Look at the 3 moves above the Asia range, right? 1, 2, pulling back into 1, and then a little 1, 2, slight 3. Look at how it's just a slight bit higher. So there was your 3-1, 3-2, and 3-3 on your stacked 3 progression up into the high of the day. Not much loitering, but definitely some loitering. Let's count it. 1, 2, 3, 4, 5, 6, 7, 8. 8 or 9 minutes sitting here at high of the day, allowing the trade systems to turn long. And then your entry would have been the close of this candle right here on the M1. And UF actually is nice because we often see very tight spreads on UF. It doesn't give wild, crazy spikes on a regular basis like the GA or GJ or some of the G pairs, right? And so it's actually a nice major to trade the M1 strategies on. You can see here, this thing basically turned into a monster. Pretty sure it was a 7-1 if you calculated it out based on a tight entry, tight stop, right? Nice zone flips as it progressed lower. You had to wait, obviously. Look at the pullback into weekly open price and then down into the Mayo. This would have been the end of your trade. So that was nice. That happened last night. Anything else? I think there was a tea time that happened as well. This wasn't the prettiest tea time. We had the best tea times on Monday. But this will still be in the weekend study module drop on Friday for you to check out. Sideways chop in the D1 chart. Somewhat of an ambiguous move here. In the H1 chart last night, we had it in range condition, and it's good we did that because what it did was it provided you this 1, 2, 3, 4, almost 5 pushes, but this is what we were talking about in the pre-market where these tea time trades come up, and it's usually a blistering fast move out of nowhere that runs into either a brand new fresh high or fresh low of the day right at 11 a.m., and that's what it did. It came down here and whipped back in one candle, right? So you have to be ready to take single spikes on tea time trades. Right now, of course, that goes contrary to what happened in our tea time trade in GC yesterday, which looks like I didn't mark that one up. Sadly, I should have marked that up. I thought, oh, here it is. It's just mislabeled. Okay, this is the epitome of a tea time trade. Just to cover the concept again, this is what was going on. Oh, it goes from GU down to GC. Sorry about that. So overlapping markups. So let's start here on GC. So with GC, you can see the progression once, twice, and then 3 up. We had this as an outside structure last night, right? But that was, in fact, if you look over here into this architecture, right? We're looking from this bottom move here would be 1, 2, and 3, and a little fourth move, a little bit of an extra bit of speed, breaking through average daily ranges, coming back into this D1 peak reset, which sadly I've got to fix this. That GC chart would have a D1 peak reset back to the left. But you can see what they do here. They just create a fresh high out of absolute nowhere, right in front of 11 a.m., which is 4 p.m. tea time, right? And they give you the M formation. So this was a very nice New York M formation on a tea time trade. I would suggest you get in on this area. I want you to high-low drill these things. I want you to get in as close to the high as possible. Don't wait for any confirmation short. Just be able to study the charts enough that you have all of your pre-shift confluences basically down. In your game plan, you're basically going in here on the top edge of these pins as best as possible. Just weather this fake pullback. Again, another fake pullback. Real fast move that goes nowhere. And they sit there for 1, 2, 3 minutes and then drop. Obviously, you could enter later as the M form, but I'd much rather you with tea time trades get in early. Okay, so nice tea time trades yesterday. So again, we're hitting basically the same amount of trades per week in terms of this blend of signature trades that we have. It's pretty reliable so far. And I got a neat Skype from Matt, who is actually going back a couple years and looking at a pre-market session and then pulling the WSM viewer up as if he was about to trade that session on the edge of price, not obviously knowing what exactly price was going to do. And then he sees a trade set up. And obviously in his mind, since he's basically running it through as a simulator, he's taking that trade. And then he goes and he looks at the database for that week, and that trade ends up on the database. So there's a consistency here that I think is something that you want to grab a hold of as best as possible. So the rest of this DMR session will be on this. This is last week's trades, right? This is last week's trade, 28 M15 and M5 trades and 8 M1 trades. And I've filtered down the M1 trades to just really have super solid ones there for you. So there's no shortage in these setups happening, right? We've got a database now that's just pumped above 5,000 setups, right? That's across every pair, all the various setups, but you can come down and whittle through that and just look for type 1s, 716 type 1s, right? So you have a large amount of trades. So let's get into the session tonight. Okay, this is again Napoleon Hill. Just seems to cut through a lot of stuff. This generation of writers and philosophers back pre-1930. I don't know what it was. I guess they hadn't put the garbage in the drinking water yet. People were usually pretty on the ball. So let's read through here. The value of actions depends on the courage they require. Ordinary people who do extraordinary things for others are those we later call heroes. When asked why they performed as they did, they often say it was nothing anyone else wouldn't have done in the circumstances. Perhaps that's their way of saying we all have the capacity for greatness. It is only when we are severely tested that we rise to the occasion and perform at the highest levels of our competence. You become a person who does the right things when presented with great opportunities the same way you achieve success at anything, through force of habit. And this is the important one right here. If you make it a practice to take appropriate action, even when it seems unimportant and insignificant, you will do the right thing without thinking. Let me just make that nice and big. If you make it a practice to take the appropriate action in trading, even when it seems unimportant and insignificant, it's boring identifying possible leg ones of type 1 London patterns, you will do the right thing without thinking in important situations, right? Something pulls you away from the charts. You're very happy you've done that work to identify possible first leg structures. Right? This is something that can't be taught. You have to be able to go through this yourself. And again, we're super happy for folks that actually trade this stuff, but I dare say a setup like this just provides the absolute most beautiful pre-trade waypoints as you walk through this, right? So that would be your first leg confirming. Now it gets very boring if you're identifying 4, 5, 6, maybe 10 pairs. If you're sitting there identifying first legs, that obviously is pretty boring, and that falls under that category there of, maybe you don't really want to do it, but it's the appropriate action. It seems unimportant, it seems insignificant, but if you keep doing it and keep doing it, it'll start to happen without thinking. And then when the important situations, like somebody comes and needs your help in something and you're drawn away from the charts and you come back to the charts, you're very happy that you've identified possible first legs because a second leg shows up on one of your identified trade pairs, right? So if you let, and this bottom part is not relevant in this case, right? You're essentially, if you let action speak for you, you will never have to worry about what others recognize your contribution. Well, that's really not what I wanted to take away from it, but in the same way we can say if you let your action speak for you, you'll never have to worry about your equity levels of your trading account. They're going to stay going upward. Okay, so let's refine this idea because it comes up a lot in questions I get from students direct on Skype. So we're talking about habit formations and how important it is, even when it seems inappropriate. The habit of scanning for waypoints as price moves is a key to being able to best execute a signature trade. There's nobody here that can execute a signature trade just walking up to a screen that I would be confident putting my money with, right? Say, for instance, I was estimating people's trade capacities in order to invest in them as I'm just going hypothetical here. But if I were out on this charter boat and I didn't feel like trading this week, who would I give my trading account credentials to trade my account? It would be someone who works as a habit that follows an execution of a signature trade based on waypoints and has a habit of just locking in that progression from A, B, C, D, E, right, as the trade plays out. Okay? The best trading comes down to simplified triggers for all actions based on empirical data applied to an average win-loss statistic. So your best trading by is always going to be when you have simplified triggers. And we can say last night, and I guess I shut his trade, unfortunately, but let me pull that back up. And I'm not sure exactly how he went about this, but I would say that he'd have an easier time setting up for this trade if he identified this first leg and then looked at the H1 chart to see the zone flip back to the left. Perhaps had a look at the daily trade organizer to see that we were in L2 short from the higher time frames, took his time, and then was present for the second leg to form and simply waited for it to close below the 13. That type of methodical approach is the way to do it, right? But you have a simplified trigger there. It's close below the 13. You're not looking at 15 things for your entry triggers. You're looking at one thing as you're basically following this thing from left to right. Okay, now I use this word empirical data. I've done some past DMRs on this concept I want to present to you, especially to newer folks. And it's in this top area. If you click this link, I'll drop this link once I show you there. But if you click that link, you're going to come down into these 3 sessions which deal with this idea of empirical. And what it does is let me just show you from the top so you know what to ignore. So ignore this top one, ignore this second one. You're looking at the beginning of this 3-part session here, which is part 1 of 3 parts covering the trivium method of coherent reasoning. And this is the gap in our education at this time on this planet in a gigantic way. I mean, the elite boarding schools still have this stuff in it, right? So you're not completely devoid of this information when it comes to our population, but essentially most of us did not go to elite boarding schools, right? Most of us did not have that opportunity to have what's considered on-the-job learning, the ability to communicate your idea to large groups of people, the ability to gather individual bits of data to then use logic in order to come to a conclusion and then convince a large group of people that that's the way to go. We did not have that to the level that we should, and it affects our trading bigly. So this is part 1 of 3. Part 2, same thing, right? With some trade stuff mixed in. It's not entirely this concept. And then, of course, part 3. And these are really juicy because what they do is they basically show you what you're missing in your Western education. And this is the kind of stuff that you would want to have applied to not necessarily your trading, but in your planning to trade. Okay, so it's a little complicated, but I understand that some of you will get what I'm talking about, right? So there's the link. Part 1 of 3 covering the trivium method of coherent reasoning. So coherent reasoning is lacking our civilization. It's just not there. And I really apologize for absolutely crappy mic performance on this. So if possible, when you're at, I don't know, CVS or whatever your local pharmacy is, grab a pair of like $9 earbuds and plug those in. And go through these 3 lessons here. They're very important because it leaves, this stuff is left out of your education, generally speaking. So that's going to put you in a proper state of mind to understand what we're going to cover here as the most important aspects of trading that are never talked, well, they're rarely talked about. The only person I've seen talk about it, frankly, is Steve and Carr, right? Doug, I'm sure as well. I just haven't watched as many of his sessions, but I know Carr's talked about it. I know Steve's talked about it, right? So the idea here is you have a habit for scanning waypoints as price moves. You have simplified triggers for all your actions based on what actually happened in past data that you've developed a statistical win-loss average for, right? You do those 2 things, that's going to set you up to trade well. Now, let's say, for instance, and I'm going to probably guess a lot of you really haven't done this, and I didn't the first couple of years that I entered trading with Steve's education. I was fortunate that I already was thinking this way, and so did some things voluntarily, and was lucky enough to go to a college that came close to the elite boarding school type of education. So fortunately, I was lucky that the school it's not that way anymore, tell you that much, but it still had enough of that learn by doing built into it that, anyway, you get the idea. So without these 2, no amount of emotional control or wishful thinking can replace these 2 vital points. So it doesn't matter what type of wishful thinking you do before you trade. Doesn't matter, if you pray to something or meditate on something or do binaural beats or any of that kind of stuff. It's just if you don't have these 2 components, you're really going to not have overall success in trading. So let's talk about what these are because it gets very important. So the first one is a proven statistical edge, right? Based on with the win-loss, right? And then the second one is a habitual routine for spotting this edge as it forms live in real-time markets. So there's two separate disciplines here. I hope you're understanding how separate they are. All right, so the first one is a win-loss scratch ratio for a signature trade for a given pair. It's vital. Without that, you're basically floating on the open sea with no bearings. You have no compass. Right? And then the second part is clearly defined waypoints or events over time. So you've managed to make for yourself a list of the progression of actions that price does in order to create a signature trade simplified trigger entry for you. Clearly defined waypoints or events over time. And this obviously is not just the entry. It's before the trade setups. It's the entry. It's the reversals that happen as the trade moves and is onward to take profit. All right, so if we were to break these down, this proven statistical edge win-loss ratio that you develop is based entirely on history. Right? That's an ability to go back in time and parse out these win-loss ratios. Okay? And then the bottom one is a methodical routine for observing the future. So one of them, you're going back and you're sifting through what's happened and you're generating a win-loss statistic that's extremely necessary for your trading. And then the next one, basically you kind of at first go back and then you go forward. You go back and look at all of these setups. If I were to take any of these London patterns that we've seen, I could look at this London pattern setup and I could devise for myself a set of 4 or 5 key events that happen that allows me to slice up time, and then I can apply that into the future. But I have a methodical routine for observing the future. That is, I can't explain how significant that is for everybody. I want you to fully understand and comprehend how that's different than just walking up to a chart and seeing if something sets up. Or let me just see if one of these London patterns is in the charts tonight. Or let me just stare at the screen without any sort of methodical routine at all and see if one of my setups sets up. You see the difference? It's more of a needlepoint type thing where you're going from A to B to C to D to E, and it's very disciplined and it's very scientific. And it's all, yeah, I would say do it, objectify it some way at first, write it down on a piece of paper, mark up the paper as price moves. Find a way to make it as mechanical as possible is my advice for you. Now, in terms of this win-loss scratch ratio, of course, we have this wonderful tool that we've all been using. Nope, not that one. We've got this wonderful tool we've all been using, and we're going to be updating this before the holidays. I want to make sure that we leave you guys, assuming you're like me, that when you have downtime, when civilization goes on holiday, that's usually the time I go to work. And it's been my habit all my life. And so what I want to do is by the time we leave you, whenever, I think is it the 16th or somewhere in December, our last session, I want to make sure you have the next version of this. But it was super simple. You're essentially entering wins, losses, right? Take profits, break evens, and stop losses in a sheet for a given signature trade. I've done a whole session on this. I'm going to make sure I spend at least another entire DMR with our new sheet, which is going to be a whole lot deeper. And we're going to cover little pieces of what's going to be in that tonight. But I want you to start to get in this habit of looking back so you can develop a statistical win-loss ratio. That's what matters. And it's all down here. It's all in this HUD. That's what you want to, that's basically becomes your home base. And let me just show you. We've used this one before. Oops, wrong one. Sorry about that. I don't know where the other worksheet is, but that's all right. You get the idea. We've used that before, and we've been trying to get you to see trading in this way. I guess the best way to say it is see it more as a probability, not as a I hope I win tonight kind of thing. And it's hard to explain the difference to most people. They don't totally understand that, right? So generally speaking, your first signature trade is all London patterns, no filters, nothing, just every single one of them. Then you start adding some filters, maybe in line with D1 trend, maybe some AFPs and level 3s. And then type 1 London patterns with D1, H1. And you can see here, you actually will start with just the pattern. Then you add some break evens perhaps on this third one. So the first one is just the 15-minute pattern, or in this case, it's 5-minute, right? And the second one, you add D1 trend along with H1 levels. And then the third one, you bring in stop loss to break even. And what you should see is a general improvement of your reward risk ratio, right? So 87% hit rate is a whole lot better than a 60% hit rate. That's the type of thing. You want to build a scenario based on historical data that puts you in the right pairs and has you watching enough pairs The big deal with this type of information, again, is the ideas behind the sheet, but it hasn't really totally been explained to you, so I want to explain it now. The idea with a sheet like this, and especially the new one that's coming out that has 12 pairs on it, is that you want to find the proper inventory of setups. And when I say proper, I'm going to define that. You want the proper amount of pairs and the proper amount of signature trades that it doesn't put you into overload. So what you would do is you back engineer that. You say, I want to make 15% a week. If you want to make 15% a week, well, how many times does GU give you a London pattern per week? And how many times does EG give you a London pattern per week? And do you really need to watch 5 pairs? Maybe you only need to watch 3 pairs. Maybe you want to mix another trading strategy in with a London pattern type 1. Maybe you want to do some M1 strategies as well. Well, the idea is that if you have information on these hit rates and you've improved them so they actually are a high hit rate, you need fewer trades because your overall hit rate is higher. So you would look for the best of all pairs for your London patterns. You look for your best of all pairs for M1 signature trades. So you see what I mean? You're assembling for yourself based on historical information the ideal number of pairs to watch and what signature trades are associated with them. Because we start out thinking we have to watch 12 pairs. Or in some cases, H150 bounce, yes, it's nice to watch 20 pairs on that. It's one simple trade that is very nice to watch a bunch of pairs with. Okay, so I want to make a little graph here for you because, again, these sheets are going to answer this question, not only putting you on the right side of your win-loss ratio, which is, we'll just say that's already explained, right? We've already talked about that. That's necessary. The other thing that these sheets are going to do is they're going to answer this little conundrum that it can't be answered just by intellectual, casual thinking. All right, so we'll make a little graph here, and we'll call this number of pairs. Number of pairs. Yeah, the mic is in the way. Unfortunately, my keyboard, the way my desk is set up, that's all right. Number of pairs. Okay. And then this bottom one, I'll just stick it along the side here. This will be number of signature trades. Okay. So now, and then we can, this will be kind of easy here. So 1 signature trade, maybe 2, maybe 3. I don't suggest you getting over 3 signature trades. If you do, you have to be very, very clear about what you're doing. So we'll just do a hypothetical there and leave 3. And number of pairs, obviously, you can start with 1 pair. All right. So with 1 pair, if you're only trading 1 pair and you want to make 15% a week, or you want to make 10% a week, or you want to make a given amount of inventory per week, if you're only trading 1 pair, the objective would be to actually have 3 signature trades on that 1 pair, right? Because it's highly likely you'll get maybe 1 or 2 examples of your signature trade on 1 pair every week. Maybe you get 0 some weeks, right? So with 1 pair, you might want to trade 3 different types of signature trades, right? If you have this is your market maker cycle per week playing out, well, you want to catch your level 3 down here. That might be type 2 London patterns. You want to catch your level 1, that's an away from peak level condition. That might be type 1 London patterns, right? So type 2, and then this one's just a big fat W with in the Asia box reversal. So that's 2 signature trades. And maybe you want to catch something up here. Then it might be an ID50. Might be something where you're catching this trend long, right? So if you're only trading 1 pair, you want to be able to capitalize on all points of it during the week, right? In order to get somewhere between 2 and 5 trades per week. All right, 2 to 5 trades per week. Remember, we walked through our little scale above the waterline matrix, and we get these babies up to 3% each. Okay, as you build your account, and you're no longer on the dealer's A book, you're on their B book, which we'll explain down the road. But they have 2 books, by the way, and it's totally legal, and it's just absolutely mind-boggling that it's legal. But that's all right. We're not here to be enforcers of what is or what isn't, shouldn't be. But you can see here that at 3% each, right? So that's your stop loss, right? So most of the trades that we're looking at are 2-to-1 trades. I suggest you want to build your strategy based on a 2-to-1, right? And that would mean that every single trade is a 6% take. Okay? So you can see what happens with the numbers now. If you're trading, if you've built your account, right, you built up from the water line a little bit, and then finally you're up at that next threshold where you can jump every single trade up to 3%. You don't really need 5 because that's going to be 30% for a week. I mean, it's fine you do, but I know people with large accounts that don't do this. They take 2 a week, right? What is 2? That's 12%, right? It's pretty close to our 15% per week, right? So, maybe you want to do 3. Of course, 3 times 6, 18%, right? So that 18% a week, you might want to settle on that. So as you get into the higher risk, based on your ramping of the water line, then you might need only 3 trades a week, right? So 3 trades a week, can you spot 3 trades out of a typical week in one pair, right? So with one pair, it becomes necessary to perhaps have more than one signature trade, right? Now let's take it the other way. Let's look, say for instance, you don't want to trade all these trades. You want to trade your H1 50 bounce. Okay, that's the only trade you want. You don't want to trade anything else. That's your only signature trade. So in this case, we'll change colors here. In this case, oopsie, you have one signature trade, right? You're only doing one signature trade. Well, if you only watched one pair with one signature trade, there'd be many weeks that go by that you didn't get anywhere near 2 to 5 trades a week. Right? So you want to get 2 to 5 trades a week. Well, guess what? You might have to work this number up, right? You might need to bring it to 10. Okay? And no one's going to be able to answer this until they actually do the work on this, right? Maybe you need to bring it up to 12. And it could be a 12 pair thing like we watch in our pre-market session. Maybe you want to bring it up to 12 pairs. Okay? Maybe you're more advanced at your mechanical ability to focus on structure and routine. And then you can bring this baby up to 20 pairs, right? That is certainly doable, right? It's just one signature trade. So you see what I mean? So if you're looking for what your inventory is going to be, it's going to vary. Do you want one signature trade across more pairs than one, or do you want several signature trades across one pair? Okay, that's what's going to happen with using these sheets, in addition to the win-loss ratio information starting to become clearer in your mind. Okay, so I'm starting to see, I haven't done it yet, and this is why I'm going to be busy logging trades over the weekend, rather over the holidays, definitely. Sorry, I'm just that way. I like time with family. It's wonderful. I do that, but at the same time, those 2 or 3 weeks of downtime is, to me, precious data entry time. So whatever type of project I'm on, that's usually where I dig in. So I'm looking at maybe 4 to 6 London pattern type 1s, right? And that would be this first SIG trade. And then my second SIG trade, looking at M1s. And I basically like 2 pairs for that, right? That'd be GJ and GU. I like those for M1 trading. Okay, so I want to find for myself what 4 or 6 pairs out of 12 perform the best with a type 1 London pattern. I think I'm going to go with the 5-minute entry on this. The M15 entries, the numbers are really high, so it's hard not to lean on those. Those are up to 80% with not much tweaking at all. The 5-minute entries on a type 1 London pattern, the numbers are a little less. But when you get up to the 15-minute chart, for some reason, those things explode. And when you start integrating zone flips and higher time frame information, sometimes that M15 chart is a little better. So it's either going to be a 5 or a 15. I'm not really sure. I guess I should have done that in blue just to keep it consistent, right? So it's either a M5 London pattern or a 15. I'm not sure yet. Okay, I've done my work on the 15 so far. I need to go back and do the 5s, and I want to do it across a lot more pairs than I'm going to settle on. Why would I do that? Well, if you see differences in the HUD from your actual investigation, you see some pairs are 60% win rate, and you see some pairs are 87% win rate, and you have 2 years of data for this. Well, then your choice is very clear. You're going for the pairs that have the higher percentage win rate. So I'm going to look for the higher percentage win rate to get somewhere between 4 and 6 pairs to trade type 1 London patterns on either the 5 or the 15, and also trade the M1 stuff. And again, I should end up somewhere around this workload, somewhere around 2 to 5 trades a week. So it ends up being about 1 a night, maybe not, right? So you're okay not trading on a given night, right? So it's either between 2 and 5. So that as a human being, your workload needs to be taken in consideration. You don't want to saturate yourself on a workload. So again, I hope this is real clear for everybody. Number of signature trades, the more signature trades you have, the fewer pairs you can watch. The fewer signature trades you have, by necessity, the more pairs you have to watch in order to meet this type of number, right? So that should be super clear, okay? All right, so let's make sure everybody knows where this baby is, because I want you to all start using this tool. It's going to be very important going forward. So we've got that one. We could just take the shortcut there. And so it's this one down here. It's a signature trade win-loss matrix worksheet 1.4, right? We're in the process, obviously, of upgrading this. We're doing another version of it. I think this one will stay the same because it basically is self-contained and absolutely rocks as it is. But I just want to make sure everybody has this other Excel sheet here. Oops, guess I didn't grab that text here. Right-click, copy, and then paste. Just want to make sure you all have this, and I'll drop it in the forum and as well post a link for everybody. So let's grab the link for that. And by all means, pay your $6 a month or whatever it costs for Excel. I mean, Microsoft Windows, like $6 a month. It's really not much, right? So let's clean that up, and then we're gonna go, and this will be bold. Okay, so this is basically at this point, I'm starting to consider this kind of thing a requirement, right? So if you want to trade well, you need to have a risk plan that's going to allow you to survive as you learn. And then you need to have some ability to go back in time and organize all the data that you have to collect. And you know, how hard is it to go back and look at wins, losses, and basically compile those? It's not that hard, right? We've made it really easy for you. So you've got the week, the names of the week. When you're looking, just a little thing here. If you're looking at 2018, you want to start on the 7th for 2018. The reason for that is that the first Monday of the year in 2018, was the 7th. So if you want to go back to 2018, you want to put this first number as 7. So we'll be dropping, obviously, the next iteration of this as we go. But it's the type of tool that you need in order to get to this next level where your historical win-loss and inventory questions are answered, right? So it's not just a win-loss ratio. It's not just how good is this pair, how good is this setup. It's how many pairs do I need to watch a night? If you can get that down to 3 pairs a night, if you only watch 3 pairs and yet you trade 2 signature trades across both of those, I'm telling you, you're going to be more productive because you're not as drawn into, all these details. You have a methodical routine to observe as price goes. It gets difficult when you're above 6 pairs. Personally, I think I tap out about 5 or 6 pairs. I get, I can just feel it. It's the drain. Okay, so no signature trade, and then we're going to talk about this methodical routine here. This is so important. No signature trade fires all at once. None of them. H150 bounce. First thing is that white arrow. I have on mine, of course. But that's, this is all stuff you'll come upon if you study this signature trade, right? There's going to be a white arrow that fires. Like, say, for instance, this one. This was nice. This was perfect, actually. H150 from Friday. Okay, the white arrow fires. Look, where does it fire? It fires at the end of the day, Thursday. Okay, so we wait for the pullback, obviously, RSI to meet the midline range. It pulls back in the midline range, and you got the close below. Tap to the water, right? So you've got all these things in sequence that play out. So you want to be thinking about this H150 bounce back here. But the first thing is that white arrow, and then down it goes. Okay, this template actually is in the pre-market templates. When you load those, I've got a lot of blank templates in there. This is one of them. So I would suggest if you're an H150 bounce trader, put a big fat arrow on there. So again, no signature trade fires all at once. It has segments which form over time. Okay, so the question becomes, how sharp is our perception of them? If we're watching too many pairs, we can't have very sharp perception as a rule. However, if we're only watching something as simple as a white arrow, a pullback into the water, and then a close below the water, and then a 1/3 pullback after you get the trigger, and then you get the entry, if that's all you're looking for, then you could possibly watch far more than 6 pairs. That's a very easy sequence of events to watch over time, right? And another thing I want to mention, this is actually very important too. As you work your way through this, for instance, H150 bounces, not a bad trade to put through this. It would be wonderful to put an H150 bounce through this. A lot of your H150 bounces, their hit rates up in the 80s. Okay, so if you have a trade, a signature trade, such as an H150 bounce that's around 80%, you can go 1-to-1 with that without a problem at all. You're still going to get your numbers, right? You're still going to get your numbers. And again, math is just so important in trading. If you're looking for this 18% a week, somewhere around 15, 18% a week, right? 2 or 3 H150 bounces, right, is not going to give you the 2-to-1 edge. So you need to actually take more H150 bounces. So how many would we need for 15, right? You would need 5. So you need 5 H150s, right? 5 H150s at 3% each, right? You're risking 3%, and you're going to get 3% because you're going 1-to-1 with it. Okay, that gives you your 15% at the end of the week, right? So essentially, you need to watch enough pairs that you can pretty much guarantee of the 20 I'm watching, I can get 5 a week. Maybe of the 12 I'm watching, I can get 5 a week, right? I see a lot of people in this upper teens area with an H150 bounce. That's okay, but it's such a simple procedure for watching the things play out, right? This is an extremely simple set of waypoints here. Okay, so the question of perception is going to be how clear your methodical routine is. But in order to maintain that clarity, you need to know what the inventory of trade setups is for your given signature trade. It might be that in terms of where I end up with my personal little 2-trade system, it might be that I don't do 4 to 6, right? It might be that basically I just do 3 of these and I keep my 2 M1 trade pairs. Maybe I just stick with 5 overall. This is the kind of thing that's not taught in our schools, is that you don't want to go ask somebody. You don't want to ask a book. You don't want to go ask a YouTube marketer. You don't want to ask all these people that have information. They're not going to give you this answer. No one else can give you that. You have to provide this answer for yourself. And the best way to provide the answer for yourself is basically getting an average win-loss ratio, but at the same time getting an idea how often they set up, which is easy to see right here. I can see how many times, just by looking at this thing, a type 1 London pattern and GU sets up on the 5-minute chart, right? 3 on this week, 3 on this week, 3 on that week, 2 on this week, 3 on this week, 2 on this week, right? With some losses in there, of course, as to be expected, right? But I get a sense, I can visually see it. So maybe I'm shooting a little high and I don't need 4 to 6 pairs. Maybe I can bring that down to 3 pairs, 2 pairs, right? Maybe I can overlap the pairs that I'm M1 trading. I don't know. And you need to make sure the biggest thing that's going to be your friend in this world is be able to ask the right questions and know that only you are going to be able to answer them and find out how to answer them, right? Don't go asking anybody else to answer them for you if it's something that's very individualized and very not like anybody. I mean, essentially this little graph here, this question, how many pairs, how many signature trades, what pairs, is one of the biggest questions you can answer for yourself as a trader. And you're going to have a different capacity to hang on the charts. I can hang on the charts from about 2 a.m. Well, I can hang on them 24/7 basically if I were awake all the time, but I can easily go from 1 a.m. to 9 a.m. easily. That to me is not a problem. I have other stuff I can do inside here, so I want to make sure that I'm looking at some type of, one of my signature trades has to be basically what I can walk away with. And a 5 and a 15-minute London pattern I can walk away from. An M1, I basically want to nurse that thing until it's done, but it's usually 40 minutes to 1.5 hours and done. But I can be at the chart between 1 and 9. Maybe you're different. Maybe you can only be at the chart from 1 to 3, right? In which case, this entire scenario changes. This whole thing changes. You're looking for probably maybe a couple more pairs, fewer trade setups, that type of thing, or maybe more M1 setup pairs. Maybe you're looking across 3 M1 pairs, something that allows you to have a 2-hour trade execution window. All of that makes such a gigantic impact. So it's this life, all these lifestyle questions you need to ask yourself, and you can't have that until you actually have the data in front of you. I propose to. All right, so how sharp is our perception of these methodical, these waypoints that play out as our signature trade is setting up in real time? How sharp is our perception of these setups? Okay, how confident are we in them? How confident are you that when you see a first leg set up on EC, let's go back somewhere else here. Let's go into something more realistic here. Okay, let's have a look here. How confident are you that you say to yourself, well, that looks like a type 1 London pattern setting up. I see that's a first leg. All right, so I'm going to put an alert for myself across here. So obviously alerts allow you to watch more pairs. Okay, I heard a quote from someone yesterday, with Steve Florian, somebody that a trader, a friend of his said, more screens, more money. I thought it was really funny. In some cases, it's true, but you have to have a system behind what you're doing. If you're systematic, it's true. If you're just drawn into it, it's not. But this is the type of thing where if you're watching a lot of pairs, you can easily wait for the restrike into the second leg area and possibly take a second leg down, right? Okay, so there you go. You've got something. Close below the catch-up. Is this a setup? Do you have confidence in this? Right? Look at your peak over here. All right? Could have done a pop quiz here, but got a lot to cover here still. All right, so here's your level 1, and wherever this baby ends up is going to be your level 2. So you're away from peak. Do you have confidence? You pull the trigger, stop loss above. All right? So do you have the confidence in that? Okay, how confident are you watching those waypoints play out, and then when you have to pull the trigger, how confident are you? Okay? And I'll ask you the question. This will finally get some interaction here going. Okay? We'll use this setup as an example. You started the day, 5,200 cross. What's easier than that, right? 5,200 cross. Level 1 condition. You're looking for reasons to go short. Okay, you got the slight break above Asia range. You have the close back below catch up, so that's your leg 1. You're assuming there's a possibility of a leg 2 over here. So you put an alert inside price, right? Not at the top edge, but inside price. Put an alert there. So you don't have to sit and watch this thing for hours. And then all of a sudden, obviously it comes back and does its thing and it closes below the catch up. How confident are you in that trade? And my question to you is, what best generates confidence? Question for the group. I want to see your answers on this. What best generates confidence? I'm going to wait for some answers to come through because this is an important one. I want to see how people are assimilating information here. Okay? And of course, you're always invited to ask questions generally. You never have to ask me, can I ask a question now? Just type it in. Okay? Okay, let's read some of these out. Consistency is what generates confidence. Work, experience, homework, repetition. Okay. Algo homework, yes, I like that. Practice, experience. What is the indicator for the alert? Okay, as you're thinking about this answer, okay, just think about what best generates confidence. Now, this is kind of a trick question here, and when I answer it as I'm intending to answer it, it'll strike you as why that's a trick question. So just think about that as I go here and find this little alert indicator that I've used that I like. I mean, there's ways you can have MT4 basically do alerts, generally speaking, but I'm answering a gentleman's question asking me what type of indicator would you use for an alert? And let's see, I don't even know if it's on this list anymore. Hopefully it is. I tweaked them, yeah. AFP chin alert, right here. Okay, that guy. Okay, so what indicator for alerts? Try this. Let me type that in. Okay, there you go. Try that one. And I'm going to go here just to show you what it's about. Okay, so it's kind of neat. Andrew updated it for me. Load the cheat sheet here so you can learn how to put it in there and all that. Obviously, you can put your own sound file to trigger it and all that, as long as you use the alert sound file, right? So custom sound files. It's kind of neat, actually. But all the information is in there, and the alert is down here. Okay, it's an MQ4, so that means you can tweak it if you have to. And then, of course, the instructions. Make sure to load the instructions. It's all in there. I explain how to load it, how to use it. Okay, so that's that. Okay, back to the question, what generates confidence? And what generates, let me just make this really clean, because I understand a lot of people are answering this generic confidence thing. I'm not asking for what generates confidence in things outside of trading. What generates the confidence in you going short here? And I haven't seen the A+ answer yet, but that's okay. And I've seen a lot of allusions to it, so I see you answering in line with what that particular question is. But my question is, what best generates confidence to follow all the waypoints and then enter here, short? Right? What best generates confidence? Okay. There you go, Al. All right, I got an A+ answer finally. And again, this is why I've directed you to that previous empirical lesson, right? Back to that DMR that I did, many moons ago, right? If you want to see previous DMRs, go into the DMR video section, go into Jim's DMR videos, and go to the first one of 2018. And then down here, sorry for the crap audio, but covering the trivium method of coherent reasoning. We're not trained to reason coherently. Sorry, we're not, right? If you were one of the fortunate ones to be in an elite boarding school, yes, you learned how to reason coherently. Okay, but we got one answer here that I like. Okay, and remember, we're looking at what confidence means: faith or belief that one will act right, proper, or effective. Right? You're going to act in a right manner, proper manner, effective. Okay, so to me, it's the math. To me, it's this win-loss ratio, and it was on the screen the whole time in front of you, and it's what we just talked about a lot about. Because at the end of the day, yes, experience, yes, work, yes, consistency, yes, repetition, all of that's correct, but it's really your win-loss, right? Your win-loss ratio. That's it. I mean, it's almost as if you want to find the core center of your confidence. That's it right there. And it actually comes down to math, right? It comes down to math. My core confidence in this thing rolling over, and we're going to cover this trade because Ambrose asked me about this and he did take it. Core confidence in this trade rolling over is that I've gone back and I've seen type 1. This is actually a type 1, right? Broke the Asia range. I've seen type 1 London patterns in line with our 5200 cross do very well statistically. We might have a high 70 or 80% hit rate on that. Okay, so this is the type of open-ended question that most of us as traders have not yet answered for ourselves. We have not yet answered that one for ourselves. Thus why we have a sheet like this. So you get to compare and build this picture for yourself to have that math in your favor that allows you to have that best level of confidence you could possibly have to be able to ride that thing short. Okay? Super important. Right? It's not some new trick. It's the math. See, a lot of trading educations are about, well, we got to show them the next trick. We got to change it up and do something new. We got to, it's always about this next trick thing. And you watch enough of these guys, you see it, right? They're going to go on to something else and something else and something else. And I mean, you might have been on that journey where because you haven't had a coherent plan to scale your risk above the waterline, you have managed to blow accounts, things like that. You haven't used a tool like this. Yeah, you've gone from teaching to teaching to teaching. You put yourself through this, I need the next trick, I need the next trick, I need the next trick. Well, it's not about the next trick. It's about the math. Okay? So important to get that. And it's really about the math. Okay, what are the waypoints to focus on as a London pattern is setting up for entry? Another pop quiz for you all. Assuming a London pattern is your particular choice of a signature trade, you should be able to rattle off in your mind 1, 2, 3, 4 things that immediately come to mind. That's like, it does this, it does this, it does this, and then it does this. And that's so you have a methodical routine that's super focused. It's not wishy-washy. It's not just staring at a screen, right? It's very narrow, okay? Yep, that's one, Johnny. What are the other 3? Right? So you've got obviously several of these. I remember my first class with Steve. I was lucky in the front row because there were a lot of people. I mean, it was, 150 people. I'm in the front row, and man, there were moments where he'd rattle off his rule sets, and it was like staggering. And then he said he was a fireman, then it made sense. But he had this routine about his rules that just seemed to be this involuntarily rattled off set of criteria. And you need to get that way with your signature trade. You need to be able to just rattle it off. Bip, 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 bip. Right? Okay. I'm seeing pieces of it, but I'm not seeing all 4 pieces together as one thing. Okay. That's all right. That's okay. That's what we're here for. Okay. So in order to have a methodical routine of observing the future, you need to have this type of thing super down pat. So if I'm trading a London pattern type 1, break of Asia range, close above the 13 EMA, close below the 13 EMA, close above the 13 EMA, close back below the 13 EMA, enter. Right? Simple as that. Okay, a habitual routine for spotting this edge as it forms live in real time. It's not a trick. Okay, so here they are from last week, right? Break of Asia range, close back below the catch-up, close above the catch-up, MW starts to form, close back below the catch-up. So you get what I'm saying? Break, above, below, enter. Okay, super simple. Super, I don't know what you want to call it, pedestrian, right? But the top traders do this to their trading systems, to their particular signature trades. They just strip everything away that's not necessary and have just super rigid stuff. There are a lot of traders, interestingly enough, in Forex that do higher time frame trading that look mostly at the fundamentals. And they have several, 1 or 2 or 3 technical entries, but they're not that elaborate. So if they're looking at PMIs stacking up over the course of 2 years and they see a trend in PMIs and they're on a D1 chart and they're trading, the pound or whatnot. The pound short was great. You could see the PMIs just folding over on that thing last year before, and it trended down. Their signature trades for entries are very basic and very simple, right? Not nearly as involved as what we would consider a type 1 London pattern, a signature trade, as it were. Isn't that interesting that this is GJ from 2 weeks ago, and then this is EC from, I think, the same week. I'm not sure. Maybe not. Similar, right? Very similar. But anyhow, you look at that level of trader, they're more into the fundamentals because they're trading the higher time frames, and their entries are rather simple. Okay, so this is what you need to do. You need to get this stuff under your skin so you can just rattle it out or type it out, peck it out, as it were. Peck it out on your keyboard. And I see, there you go. So nice going, Ghislaine, Al, Vladimir. Okay, good. Seen some progress there. Okay, so we're watching this thing peel over. Okay, so we spent last DMR, this entire DMR, in the build up to this entry. And so now we're going to carry through on this. So now you have your second close, right? You had your first close. So this would have been, this guy was your close below, close above, close below. So your entries here. We talked about stop losses and all that last time. It did a pullback, gave you a third leg, and then closed down below. So you have to be ready for this third leg. And wouldn't it be nifty to have that on some type of data sheet like this? How many of these give BCMs, board clearing moves? Wouldn't it be nice to be able to have? I'd like to have that. Okay, so this is not a board clearing move. This is the third leg. This is actually another parameter. Cough, cough. Right. So a board clearing move. So how many M's give a third leg? I guess that would be a statistical thing. How many times do I see a third leg on an M or W? Okay. As if we don't have enough parameters going, but that's all right. But that's not a vital one. But you get what I mean. The BCM though is very important. The BCM is when they come up on that third leg, and then they come back down and continue rolling it over. That's a BCM. That you definitely want to have stats on. And it would relate to your stop losses. Many times you get stopped out on that move, right? You get stopped out on this. It's a board clearing move where they come above, stop you out. And what you have to do is you have to have the confidence, again, based on statistics, when they close back below that 13, you get back in that thing. Okay, so board clearing move, that's on our parameter sheet in our next iteration of that Excel sheet. Yeah, the third leg, we could put that. I don't think we need it, though. Anyway, we could be all here all year doing adding stuff. But anyhow, this trade worked quite nicely down into week open price. This is price open for the week. Okay, so now we're always very interested in knowing what this distance is. Okay, if we get statistical, this is the type of thing you're going to want to follow. M1 full screen optional charts. Basically, it's this exact same pair, exact same day, and I'm using my optional full screen charts. Now, you should all know how to access these and know how to build these into your into your WSM viewer. And we'll go back to where this stuff is. Right, every week I post these extra charts. You have to manually extract them and then manually put them in the proper folders. But right here is your M1 every increment. It's about a 3 gig file. It's pretty large, but it gives you every 1 minute of your M1 charts during most of the day. There's a filter on it so it shuts off during Asia so we don't bog you down with a 6 gig file. It's a 3 gig file, but it allows you to actually walk through and find the lowest candle. All right, so M1 full screen optional charts, useful for assessing more precise pip distances. Okay, so my question is, let's back it up 1 second. To me, this is your first impulse, right? That's impulse number 1. It's on a 15-minute chart. You see that. I want to know what the distance is on that. And the way that I can tell, I can look at this 25 pip difference, right? I can roughly say it's around 30 pips. I can just generalize that. Or I can go to this M1 full screen optional chart. Maybe you're not even an M1 trader. You don't really even trade the M1, but what this is useful for is it actually gives you the pretty precise pips to high of the day. So I was off a little bit. I was a little short. It's actually 36.8 from where price is currently. So we could add a little bit in there. So it's probably around 38, probably 38 pips on this entire move. So this from top to bottom was about 38 pips on this type 1 London pattern away from peak that had 3 legs. Okay, so that's the way you use the M1 charts to gather for yourself that distance. And that distance becomes interesting because statistically over time, the GJ will put in this distance, right? And when you know what the average of that is, and you know where the deep one is on the deep edge, then you can estimate where the end of this first impulse is. And that's something that Steve's mentioned before. Now we will have a way for everybody to dive in and actually tabulate all this for your particular signature trade, for your particular pairs that you want to do this in. Okay, so that's impulse 1. Let's just declare clearly what these are. So an impulse 1 would be an M15 chart, the first large shift. You can consider that the shift. Then you'd have correction 1. That's a distance as well. There's an average distance for those in GJ. And then you have impulse 2 into correction 2, into impulse 3, into correction 3, and then end of day. Okay? So as you're determining what type of trading system you want to have for yourself with all this complicated stuff, are you the 1 to 3 a.m. trader that wants to just get in and get out and still get your 15%, 18% a week? Possible, definitely possible. You might have to watch three pairs on your M1 signature trade, but it's doable between 1 and 3. You could possibly get, I'd rather this be about 4, right? So scratch the 3. I'd rather you be 1 to 4. Maybe 1 to 5 is probably even better. 1 to 5 is ideal, but not everybody can afford to take that amount of time. Maybe you want to stretch this over from 2 to 5, something like that. Okay? And again, this is going to be interesting when you can go back in the statistics and see how often does my trade set up before 2 a.m. Not that often, right? So you can pretty much park yourself from 2 to 5, 2 to 4. Right? If that's your type of trade, then you want to take only this first impulse. Right? You don't want to sit and wait for the correction and then the impulse 2. That's going to take too long for you. That's not your thing. Okay? Conversely, if you're the type of person that has, unlimited time in front of the screen, 1 to 9, well, then you can go for impulse 2 easily and you can weather that pullback, right? So you can weather the pullback into correction 1 and then the move into impulse 2. Even if this is 6, 7, 8 in the morning Eastern time, you can still basically get away with doing that. It's not a problem. Okay? So in terms of these impulses and corrections, we've got our 1, 2, 3s that we've identified over time. But I wanted to just make these names extremely clear for everybody. Basically, pile drive these into significantly reinforced concrete here for us so that by the time we get into the next version of this, we'll have a better idea of what that means. And we'll be able to enter that data in. The whole idea is that we want to be able to get you so you're entering win-loss data, but at the same time, if you want to enter any of these other confluences, you'll be able to enter those in as well at the same time. You won't have to go back and redo stuff. The biggest problem with databases and Excel sheets and databases is like you got to do it once and then you have to go back and do it again. And maybe a third time. And that's what we want to try to avoid with our next design improvement on it. Okay? You've got to know what these mean. Impulse, correction, impulse, correction, impulse, correction. Okay? So that should be real clear for you. Specifically designed signature trades will target 1 or more impulses. So you'll design your signature trade. You'll design your system. I mean, it's obvious that you can get 2 to 1 inside of the first move and 3 to 1 inside the second, right? That's kind of simple, right? Your M1s and M5 strategies, or London patterns, we'll say, your entries on an M1 and M5 chart, pretty easy to grab a 2 to 1 off that first impulse. Okay? M15 chart, you need to have the second impulse to get your 2 to 1. Right? This might be a 1 to 1 because your stop will be above the high of the day and you might be in a bit lower. So a 15-minute chart, you're basically going to expect a 1 to 1 move into your first correction. And then when you get to the second correction, you're down into the 2 to 1. So a 15-minute chart, you might have to wait a little longer. Sometimes the 5-minute overlaps with the 15 as well. But these are the types of things that will incline you to work out. And then, of course, you get down into the impulse 3. That's actually statistically less probable. I know it's something that we teach and we make it appear that every single pair does this every time, but it's actually not true. It's actually a little less probable, this move down into this impulse 3, although sometimes the impulse 3 is the most significant and longer move. Still, you want to park yourself on these first 2 for high probabilities. Okay, how long will you be able to sit in front of the screen? We just covered that. Short time, target correction 1. Longer time, if you can sit in front of the screen longer, target correction 2, right? And in this case, correction 3 is always speculative. So I could have said the impulse. So really target impulse 1. I guess I said correction because the end of an impulse is a correction, right? So get your take profit on this one. If you sit in the computer for a short time, get your take profit on this one if you can sit a little longer. Correction 3 is almost always speculative. So shoot for this big 3 down here. Okay, 38% of the time, last I saw someone who went back and did the work. She did this on GU, I believe. And I'm not sure if she's here tonight, and I do have to fess up to say I think this was Patty. Patty Price. I'm assuming. It might not be, but yeah, it could have been her, someone else. Who was it? I don't know. I apologize for this, but someone did the work and they said, Jim, you're right. Don't hold into New York session. Look for the second impulse and be done, because this one only did it 38% of the time in the last year and a half that she went back and looked at it. So we've got our sea legs with us with going back and doing the algo historical work. So you've already hopefully sunk your teeth into this idea of going back and looking at statistics like that. When we drop the sheet in the next week or so, you'll have a more organized template to work with that can structure your algo historical work in a completely upgraded manner, so that through the holidays you can be a junkie like me and sit in front of the screens and algorithmically backtest stuff. I call it backfesting, not testing anyway. So you get the idea. So this move to impulse 3 doesn't happen all the time, right? So your correction 1 is your highest probability. That's something like what we saw here with Jake, right? That's just one. That's the first impulse, bam. And if you know the distance of this impulse, if you have a good idea of this distance, it's 18.8 here on EU, currently with a little bit of, it's probably about 20. Okay. If you have this distance in mind, you're able to statistically target that area and you get your pull out of that. Again, if you're thinking of a shorter time period on the screen, you want to use a smaller time frame to get in and then get out. I know he likes to be able to do that so he can keep a realistic time schedule for his lovely wife and himself, right? And have a day. On the West Coast, it's actually doable. You stay up till about 2 or 3 a.m. and then just sleep in and you're good. You can keep that schedule pretty well. London session opens at midnight on the West Coast. So you can go from midnight to, I guess, it's 6 a.m. Eastern, which is usually late. You can basically get done what you need to have done from about 11 p.m. to about 2 a.m. on the West Coast. And you go to bed around 2:30, 3 o'clock. And then you can pretty much stay on the day schedule. So West Coast, you guys are pretty lucky in terms of these London pattern single impulse take profit signature trades. Okay? So your median probabilities is correction 2. So correction 1, highest probability. Correction 2 is your median probability, right? Or the impulse 2 rather. This impulse, third impulse into the third correction is the lowest probability. Again, 38% from one of our users. Again, I apologize. I'm not seeing if I can't tell if she's here, so I do apologize. But that work has been done. You need to obviously think about this prospect and go look for yourself. You'll see that's most likely true. So we want to measure these impulses for each pair we are trading so as to target take profits within an average distance to them. So would you want to, if your average swing, in this case, just take a guess here, 38 pips, would you want to have your take profit at 38? Well, you probably want to do it within it. So maybe you'd want to have your take profit sitting at around 35 or 34 pips from the high of the day. See, it'll settle you into a warm zone, as you could say, a higher probability warm zone of this first correction based on statistical historical data. And then you'll have that extra bit of confidence. Well, maybe you want to dial in a 2-to-1 that's going to fit that. That's definitely possible on the 1 minute and the 5 minute chart. Okay? So it does actually make a whole lot of sense to do this. Statistics need to be done for each pair, though. This distance, impulse, and correction, those are going to be different every pair. Obviously, we know this. And I know for the longest time, Steve said he did this on a couple pairs, and he dropped his numbers into a session for everybody. And everybody's like, when is Steve going to show his numbers? Did Steve drop me? And it's like, this is the kind of stuff that happens when we're monkeys. Unfortunately, we've been trained to be monkeys. Go over the trivia method of coherent reasoning, 1, 2, and 3, and just shake this crap out of you and say to yourself, it doesn't matter what Steve dropped. He might have been wrong about it. Heck, he's trading futures. The distances on futures aren't going to be the same in spot. It's a different market, right? So, you know what I mean? You go back and do this kind of work on your own. It's, that's, trust but verify is what it is. And a good buddy of mine who got me into trading, one of the guys that got me into trading said, trust no one. He said, don't trust anybody. Check it all out for yourself. Well, I thought he was a little whacked at first, but then maybe a year into it, I realized he was dead on. Right? So do it yourself. Find those distances yourself. It's going to be different for every pair. Okay? What again brings confidence into our trading? What brings confidence into our trading? All right? Again, rhetorical. I don't need you. I put you guys through enough of this Q&A. Math. It's the math. That's what gives us the confidence in trading. So it's math and statistics. It's statistical math. It's math with an average associated to it. Okay? Neat story here. Let's just go into some, it's trivia, but it's really not. again, it's going to loop into that. This is what's so funny about our culture. There's no shortage of places in our culture to prove that we're 90% monkeys in human bodies, right? Because of what's been left out of our education for the past 100 years. And in some cases, they've been steering us to be even more chimp-like. But that's where statistics comes in, because that's the big answer in math, and do it yourself, right? That kind of thing. Okay, so when you're talking about the confidence of the pilot of a space shuttle, right? When they re-enter, they're at a 40-degree angle like that. That's their angle of attack at the highest possible amount of heat that those shields generate. And that's all based on the math, right? So people had to do this. They had to go back and test stuff. They had to test things in furnaces. And they had another vehicle. You've probably seen it before. It was the $6 million man vehicle that was used on the front of that show. I'm dating myself by that. That was an old TV show when we were little kids. And that type of vehicle was tested a lot. They got an idea of the proper angle of attack. And you can see here that based on the peak heating, right, that's where they keep it at 40% pitch, or rather attack. Angle of attack is 40%. Now you can see over here, 40%. As the heat starts to really pedal off here, you're actually then starting to get the nose down, all right? So there's an entire range of re-entry on the space shuttle that necessitates a fixed 40-degree angle of attack. And then when they get to a certain velocity, a lower velocity, right? Lower velocity, lower heat, right? Then they can start to dial it down. And then the angle of attack eventually gets to be down almost to zero here. There's a bit of nose down on the final landings. I'm sure you've seen it a little bit. It's not shown on this chart, but there's times that they drop the nose, obviously. You've seen shuttle lands, right? So there's a lot of math that's involved with this idea of, it's not just some talented pilot that says, yeah, I'm good. You know, I did my what are they called? Affirmations today. I've got my binaurals going. I'm going to land the shuttle, man. Now, that ain't the way it does it, right? This is the way they do it, okay? Their confidence comes from math, okay? That's just basic orbital math. That isn't heat. That's not your thermodynamics. That's just orbital stuff there, right? But the idea I want you to see here is that even in trading, the same type of overall idea applies. Is it pilot skill that drops one of these beautiful birds down in Edwards Air Force Base? You know, is that what's going on here? Well, if you study what these guys do, they really are not even touching the stick. You know? No, it's the math that does it. It's all the math. The math does all of it. Okay? And you have certain pioneers back in our times. Kathy Johnson, right? She's pivotal in developing the type of math that went into designing how rockets come out of orbit, right? Black lady, American. You know, what is this, the 50s? And this crap that they've got us on TV now, getting us, pissed off at the races, and, women don't have enough, and there's all the, no. This is the 50s and the 60s, folks. There was no, white guys didn't put rockets into orbit. I hate to break it to you. It was a lot of people, and it wasn't just men either. It was men and women and black women. Here's another one, Mary Jackson. She was also involved in developing the codes that allowed the shuttle to actually, this is before the shuttle. This is Apollo level stuff, right? Apollo coders. Mary Jackson was pre-shuttle. Kathy was way pre-shuttle. Kathy was back in Gemini and all that, like Apollo, right? So this is people working on math. These are brilliant people, right? And it should change your paradigm. So if the TV ever tells you you're underprivileged or whatnot, and you fall into that mind trap, just remember NASA was built by these ladies, in part, right? And of course, some white dudes that are Apollo coders, right? You don't want to say they're not. I mean, you get the idea. Like so much of this current stuff is just a joke. And female stuff. They're females. We're not given equal opportunity. Margaret Hamilton basically almost hand wrote all this code at MIT, right? Almost. She had a team, right? The Apollo guidance computer, source code, leader of the team that developed the flight software for the frickin' Apollo that landed on the moon several times, right? Orbited the moon before they landed on it, right? So this is all math. All of this is math. It's all in the math, guys. Just want to make sure that's super, super clear. Right? Yeah. Hidden Figures movie. I'll check that out. I look forward to it. There is a movie on this. A lot of you are typing that in. Oh, cool. I was just looking I wanted to get people out of this idea of, happy-go-lucky trading and into this idea of science. And I asked myself, what's the most complex thing humans have done? Space shuttle. And then I started looking into all the pictures. And the math. And I typed in maybe into Google Images, shuttle math, orbital math, and it took me down. I mean, that there's a movie on this, that's fantastic, but I don't need a movie to tell me. I was able to pull it right out of the search engines, but I wanted to get something that shows you that the most difficult tasks that are done now, where these pilots walk out of the shuttle and they're wearing those nice blue suits. They walk out and, they go and say hello to the press and everybody's like, hey, how you doing? 90% of people think those dudes did it all, right? They have no idea about this lady actually coming up with the source, the very basis of orbital math, right? They don't, so it's the same with trading. People don't understand that pro trader has done all of this kind of back end work that gives them the confidence to do stuff that's, crazy. It's crazy to enter in a flaming ball like that. And these are crazy things that the math gets you there. All right. I'm going to check that movie out. That's cool. Hidden Figures. Excellent. All right. So you're in your first impulse. Now we're going to look at the fib trailing thing. We're going to just mention it a second here. I don't want to dive too deeply into this. Let's see how we're not doing so well on time. But I have, here, only about 40 more slides to go. Oopsie. We'll cut it and we'll bookmark it like we did last week. Okay, so you're in your first impulse move down. Now, I'm talking about the folks that are doing this thing. Okay, you're taking that first impulse and it pulls back. What do you do, right? You're only 1-to-1 here on this, or a little bit over 1-to-1. I'm just generally guess 1-to-1, okay? You're a 2-to-1 trader, so you want to get this thing lower, right? So what do you do inside here? That's the question. Okay, we have this little fib trailing technique. It's a trick, but it's not a trick for kids. Okay, so in your mind, these are the fibs that are necessary to deal with for this particular technique. You do not need any other fibs. You don't need the extensions. You don't need the 236 and the 782. Get those out of there, or the 786 or whatever it is. All you need is a 61850 and 382. And I even, in fact, get rid of the 0 and the 1. But I want you to visualize this. Just get a sense of the distances, okay? So I want you to be able to visualize this because you'll be able to use the viewer without a fib and easily be able to eyeball this stuff. It's not hard to look at where this 618 is and where this 382 is and basically mirror it over here. So let's draw it in there, right? So do this for yourself a couple times. On an MT4, pull up a fib and ditch all of the other fibs. Have only the 382, 5, and 618. Put that on a chart and then see how it lines up and then draw it out. Okay, so we can draw out a fib here. Let's see that our 618 is right back into this top edge area. This is the 50, this is the 382, right? You're drawing from the top of the move in line with price, in the direction of price, into the bottom of the swing. So impulse 1, we're going to do a fib pull down to the bottom of that, and you're going to see a 618 park itself right above here. Okay, for this particular signature trade, that would be an M15 type 1 London pattern. You'd look at possibly getting your stop loss above that 618 to be able to weather the possible pullback into the 618, and then they run it on down into impulse 2. So this correction oftentimes does get all the way back up to the 618. I'm not saying right at the 618. Leave a little room for it to wiggle around in there, but generally be ready to scratch out of your trade if it starts to really make moves higher and puts in some zone flips up here that shows you that there's volume below price that's starting to push it higher. Remember, a zone flip is caused by volume. A zone flip cannot be caused unless there's big volume in there doing it. So it's a giveaway. It's a tell for volume. Okay, so I got this question from my buddy Ambrose. Took 2 trades this week, EC and GU. I hit TP on GU and scratched out of EC after my scratch rules were triggered. EC trade, my scratch rule that I applied to EC is a close above the 618, and price stays above the 618. Although after I scratched, it turned back and went into my expected direction and even hit my expected take profit. Okay, so I answer him, and I do a little drawing here. So this would be the caveat that we add to this. So you're looking at a 618 pullback, yes, but where's the 00 figure in relation to it? So yeah, when a 618 is near a 00 figure like that, let them come back into the 00 figure and slightly beyond it to trigger false breakout traders above it. So there's an exception to a 618 pullback here. And I say here, 00s can act like magnets and can go over, they can overpower the 618 area. Okay, so let's look at where we're talking about here. And this was the chart he sent me, right? His entry was on the close of this candle, right? Got the move down in a positive, and look at it sitting here closing way beyond the 618, but look where the 00 is. See the 00 figure in here? You've got to be willing to let them come up to the 00, play a little bit on both sides of it, and then scratch your trade. Yeah, you're getting into a deep scratch, but you're still not where your stop loss is above the high of the day, right? But when you're dealing with the 618 as a filter for weathering the deepest of all pullbacks, remember, sometimes they only come to the 382 and dump off. It's not always that they come all the way back to the 682, but 618, but you have to be ready for them to do this. Okay, if they do come back to the 618 and there's a 0-0 in range, let them work that 0-0 and then have it run off. So let's go look at Ambrose's pullback here. Okay, so there you are. So again, I want you to get in the habit of being able to draw this stuff out. So again, the top part of the fib would be right here. The bottom part would be here. Your midline would be the 50, so that's the middle 50. And then remember, the 618 is a little above and the 382 is a little below. So ideally, we're looking for any type of movement that sustains above this area is caused to possibly scratch. But we're so close to the 0-0 figure that we have to include that in there. So you would, in a sense, you'd shift it higher in this one instance. Okay, so look what they do on that 0-0. Let's go look at the M1 in there. Okay, so usually the M1 gives a little story, nice vector. All right, so one single long bar, a little tiny vector candle, bust through the 0-0 to trigger up breakout orders, again, to go long, right? And to shake people out like Ambrose, who got it right. And then it rolls over and that's it, right? It rolls over and that's it, and it's gone, okay? So just remember this type of thing when you're doing a 618 pullback filter, that a lot of times it'll basically run over there, okay? So it'll run over the 0-0 figure. And it might even come back and hit it again. This one came just in front of it. You got to remember, these are like magnets, these 0-0 figures. Okay, so let's continue on here. And I wish we had 2 hours to go because there's a lot more to cover here. Okay, so there's your pullback to 618. Be ready for that. It does it. It does it. Look at the inverted hammer. It's a beauty. Right there, inverted hammer at day open price. This is a different trade, obviously, than Ambrose trade, but same principle. This is more of a 0.5 into the middle. It wasn't quite the same. Maybe it was the 618 actually looking at it. Might have been up there between 0.5 and 618, somewhere around there. Okay, and then this is your M5 chart, and you can see this. And I think we'll go ahead and start the DMR on this question next week. I don't want to get in the way of the pre-market session, so we'll go ahead and put a bookmark in it for tonight, guys, and I will invite you to the pre-market session. We're going to just shut down and open right back up, and we'll go look at the charts for tonight's trading session. I do apologize for having too much stuff to fill in an hour and a half, but well, we'll get to it. This is important stuff. So again, thanks for your participation, and have great trading tonight, and may Providence be with all your trades tonight. Good night, everybody. See you in the pre-market in 2 minutes. Bye for now. Starting with our disclaimer, trading involves risk of loss of all or part of your trading in your Western education. And this is the kind of stuff that you would want to have applied to not necessarily your trading, but in your planning to trade. Okay, so it's a little complicated, but I understand that some of you will get what I'm talking about, right? So there's the link. Part 1 of 3 covering the Triven method of coherent reasoning. So coherent reasoning is lacking our civilization. It's just not there. And I really apologize for absolutely crappy mic performance on this. So if possible, when you're at, I don't know, CVS or whatever your local pharmacy is, grab a pair of like $9 earbuds and plug those in. And go through these 3 lessons here. They're very important because it leaves, this stuff is left out of your education, generally speaking. So that's going to put you in a proper state of mind to understand what we're going to cover here as the most important aspects of trading that are never talked, well, they're rarely talked about.